Hello, everybody, and welcome to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, and it is July 13th, 2022. And joining me, as always, is Arusha Pires, O'Neill Global Advisors Portfolio Manager. How are you doing, Arusha?
I'm doing well, Justin.
Okay, and we're glad to have back on the show Ken Shreve. Ken Shreve is a senior markets writer with us here at Investors Business Daily. I've been working with Ken for, over 2 decades now. We were
Over 2 decades, yeah.
over
I
two
think you're
decades.
right.
It's incredible. I mean, I remember Ken when I first started, you were on the computer answering questions from people that were coming in on the AOL.com account because we didn't have our own investors.com account yet. We had just one single homepage that just basically said "Can Slim." Here's what it is, and that was it. Yeah, so we've been through a lot, but of course, Ken is now a senior markets writer. He is one of the co-managers of the Leaderboard Model Portfolio, one of those products, and a frequent IBD Live panelist. So, Ken, great to have you on again.
Hey, always great to be on with you guys. Appreciate it.
And this is such a great time to have you on because, of course, a lot of times on IBD Live, Ken is the one filling us in with all the news headlines. And, of course, we had some news headlines today that would be pretty good to cover. So we'll cover that first with the market. And a lot of people are also excited to have Ken talk a little bit about bottoming bases, especially given where we are in the market with this correction. A lot of people wondering, okay, what's some early entries that we can get in? And one of those is by looking at bottoming bases, not necessarily waiting for it to get all the way back to new highs. So Ken will kind of give us some examples and his take on that. And then, of course, we'll also end the segments with a look at some potential stocks that are setting up. So let's get right into it. And maybe we start with the NASDAQ composite. I think the main thing that we've been talking about is how we got turned away from the 50-day moving average line. And then, of course, a lot of people had their eyes on this CPI report that came out this morning. So, Ken, what was your take with the inflation numbers?
Well, I think the market was hoping we would at least get an inline number. I mean, we knew the numbers were going to be huge, and they were. But the problem is they were hotter than expected, especially year over year prices up 9.1%. That's on the heels of it was an 8.8% consensus, so that was higher than expected. And just in general, it was a number that the market didn't like. It sent bond yields higher. It raised the likelihood of an aggressive Fed having to be possibly even more aggressive. At one point Wednesday, the odds for a full percentage point hike, 100 basis points, rose to above 50%. So, that's a pretty big deal. So here we are in a position now where, the 75 basis points is baked in at the end of this month, and then come the August meeting, we'll
September,
probably see another.
Right? They're going to skip August.
September, right? We skip August, and then September another 75 basis points. So we're probably going to get two aggressive hikes in a row by the Fed, and then what happens after that, we'll have to see. But the inflation data, consumer prices Wednesday, was not what the Fed wanted to see. It was curious to see the reaction of that 10-year Treasury yield, because in pre-market trading, it was trading around 2.95, and then the inflation data came out and it jumped up to 3.02, which made a lot of sense. And then by the close, it had completely fallen apart. The zero TNX chart in MarketSmith just showed a really sharp reversal right at the 50-day moving average. So kind of curious action in the 10-year yield on Wednesday, but the 10-year yield has inverted with all sorts of bonds and notes out there. The 7-year, the 5-year, the 3-year, the 2-year, the 1-year, all inverted. So you're getting so we know the economy is slowing down. The question is, how bad is it going to slow down?
Mm-hmm. Yeah, and now with all of that bad news out there, somehow the market gapped down, but was able to recover most of those losses there. What are your thoughts on how the market's acting over the last few weeks?
Well, I'd have to say that it's acting better. I mean, listen, we were all encouraged to see this. Nasdaq was down 2% intraday on Wednesday, and then it came all the way back and closed. And well, it turned positive. It closed with a minor decline, down 0.1, 0.2%, but still, it closed well off lows, just like the other major stock indexes. So it does seem like there are maybe a little more buyers around, maybe than in prior weeks when we're trying to find a bottom here. I mean, we're still we still have an uptrend that's intact because we're holding above those lows. The distribution day count is still relatively tame. It just remains to be seen, if we're going to get one on, on Wednesday, because NYSE volume was pretty close. So, but I think investors are getting a good lesson of the challenges of overhead supply, because we started off the show by saying Nasdaq, rallied up to that 50-day moving average and just got hit with selling pressure, and they're still challenged. We're probably seeing maybe slightly better action in individual stocks, but it's still a pretty challenging market environment. And if you're not trading and taking quick gains when you have them, you're probably giving those gains back, and maybe going back to break even or turning negative if you're not quick enough.
Right. And, you mentioned that we are in a confirmed uptrend, but under pressure. So just kind of to let people know, June 24th was the follow-through day, and that's when we switched to confirmed uptrend. Again, not necessarily saying that this is going to be going up to new highs, but hey, to start looking, I guess one of the things that we've been struggling with is there really haven't been as many setups as we usually like to see. And then number two, one of the reasons why we went under pressure was because 2 days after that follow-through day, we closed below it, and we've really kind of struggled to hold above that follow-through day level. So you got to figure, if you can't even make progress above your follow-through day, then what chances do you have of sustaining much of a rally?
Yeah, I mean, this is the main challenge right now. And while it was good to see the market, really shake off bad news. I mean, we closed lower on Wednesday, but again, the Nasdaq did, it paired a 2% intraday loss to basically break even. So that's impressive. Showed that there are still some buyers out there, but it is difficult. Listen, we've all been in markets where the stock market serves up new buys on a silver platter, and you're just wondering, okay, what am I going to buy? There's a lot to choose from, and it seems like it's been a long time since we've been in that situation. Mm-hmm. We'll get there again at some point. Might be difficult to do during the summer time, when we're in this kind of low volume period where we'd like to think that new money is going to be coming in from the sidelines, but the summertime is typically tough to get that to happen. Maybe when the people come back from summer vacation and we get to August and September, it'll be a little different, but probably be challenging throughout the summer. We'll see.
Yeah, Arusha, do you make any allowances for summertime? I mean, there's the old adage of sell in May and go away. Yeah. And we've had Jeff Hirsch on the show from the Stock Traders Almanac talking about some of the seasonality. But how do you handle? Do you just kind of lay low on summer, or are you taking it by the market action? What's happening?
Yeah, I mean, I typically will lay low, but and because I know it's not reasonable. I mean, if you see a good technical setup, and a stock is up 4 or 5% and just clearing a pivot point with conviction, it's probably a tall order to think that volume is going to be 300, 400, 500% above average. So if I can at least just get a little bit of volume, even if it's below average, but nicely higher from the prior session, sometimes I'll nibble at a new buy. But you definitely have to temper your volume expectations during this time of year.
Yeah, and Ken, how are you applying some of these? Obviously, and you've been doing this for a long time, and obviously this is like challenge environment. What are kind of some of the steps that you're taking in leaderboard, or are you just kind of being a little bit more cautious, trying to hang on to some of the positions that you guys have had for a while? What are your thoughts about kind of applying that to the model portfolio?
Well, we're really just acting the same as we do with our individual portfolios. We know it's not a time to have aggressive exposure to stocks, and those of us on IBD Live are very lightly invested, maybe 10, 20, 30% tops. And right now, at least. As of earlier this week, we were about 23% invested on leaderboard. So we're chomping at the bit to put some new names to work. And we actually tried a couple names last week, and they didn't work. They got caught in Tuesday's downdraft. But we understand that any new buys, even if it's a 2.5% position, we have to be prepared to cut a loss short if it doesn't work out, and that's fine. We can always overcome small losses. It's the big ones that can do the big damage.
And as you mentioned, both of those were smaller positions. So even though they were tried, they exited, but it wasn't too much damage because, as you mentioned, they were quarter positions, so very small. I'm sorry. Go ahead, Arusha.
Oh yeah, well, just very quickly, it looks like we didn't get distribution day on the S&P.
Oh, you're looking at the final numbers?
Yeah, so just got the final numbers.
This just in.
Exactly. Yeah, so we avoided a distribution day on the S&P.
And we have kind of day after day here lately. The volume has been coming in lower, so that's
it is a bit curious to know. I mean, we only have at least through Wednesday, we only had one distribution day on the on the Nasdaq, and just a couple on the S&P 500. I will say, with that early volume look that we get right around this time, we actually use AP data for NYSE. That comes in a little bit later, so it tends to match pretty close to what you're looking at, Arusha, but we got to wait another 45 minutes to get the final read. But it does look like it's a close call, but it could end up being lower volume. Yep.
Right. So Arusha, for you, again, this lower volume that we've seen has avoided distribution, but in a lot of ways we haven't seen much volume behind some of the buying either. Is that something that concerns you?
Yeah, that always will concern me, especially when you're in a trickier environment. Now, this is definitely not one of those kind of environments where you want to get, like Ken was saying, where you want to get too aggressive or go in too large of positions. Take a few positions, and for some of these, I've been trying to hold off a little bit, also on buying on strength and buying too many breakouts.
Yeah.
Right. More kind of pullbacks, and but I'm not even doing that much. So I have a couple of very small positions right now. I haven't gotten stopped out of them, so I've just kind of put out some probes just to get a little bit of feel. But I agree with Ken earlier on, where the market's had opportunities to go lower over the last couple of weeks, and it hasn't. And so maybe you're finding some buyers, maybe the sellers are completely exhausted here, but it at least for now, it just seems like the market's a little bit more resilient than I would have thought. So it's hanging in there.
It just seems to be shaking off bad news a little more than expected. And I know David Ryan on IBD Live has said that in recent weeks as well. But where we're at now, listen, the indexes are still challenged. I mean, what we all want to see is just let's see what an initial move above the 50-day moving average for the Nasdaq and the S&P 500 looks like. If it happens in light volume, I'm not going to say, oh my God, this is it's not going to work. But I do want to see the indexes, if they can eventually get back above the 50-day lines, see if they can hold there and at least kind of move sideways. I mean, if they go above the 50-day line and then the very next day they're down and heavy volume and there's a reversal, well, I mean, the market's message there is pretty clear. So if we can eventually get above the 50-day line here and then maybe build a new home above the 50-day line, then you can feel more comfortable that we could have an uptrend that could have some staying power.
And just to tie a bow on this segment, we've been talking a lot about the Nasdaq, but let's maybe kind of bring in some of the other indexes here. The Nasdaq certainly seems like it's been the stronger of the indexes. It was the only one that really got up to its 50-day moving average line. The S&P 500 fell a little short. It's just seemed a little weaker. Any comments on what's going on with the other indexes in relation to the NASDAQ?
Well, I mean, again, you're right that the Nasdaq, has gotten closer to the 50-day line than the S&P 500. So, but the S&P 500 that also closed, nicely off lows on Wednesday. So the same thing here. We just need to see some renewed, price strength in the S&P 500. It's been real tough for the S&P 500 because these energy stocks have been caught in pretty nasty sell-offs, and when you look at the some of the worst percentage gainers in the S&P 500 in a down session, at least recently, a lot of it has been just relentless selling in a lot of different oil and gas stocks. So kind of makes sense that might be a little further below the 50-day than the Nasdaq. But just like the Nasdaq, we need to see this index get back above the 50-day line, and then the next challenge there will be to conquer the 4,000 level. So there's just a lot of challenges ahead for the indexes, and a lot of challenges for the stock market. Just trying to get rid of all the uncertainty out there, because there are just so many unanswered questions, and when there's a lot of unanswered questions out there, that's typically when you're in a bear market, and having new uptrends have a hard time making headway when there's a lot of uncertainty.
Yeah, and of course that uncertainty can lead to more volatility, bigger moves day to day, and a lot of times a lot of back and forth action due to that uncertainty. So when we come back, we're going to talk to Ken a little bit about bottoming bases and go through some examples for that. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. And welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with our weekly guest, Arusha Pierce from O'Neill Global Advisors. And our special guest this week is Ken Shreve, right here from Investors Business Daily. He's a senior markets writer here. So Ken, one of the things that's kind of been tricky about this market is we have so many stocks that are trading below their 200-day moving average lines. So what's an investor to do rather than waiting for some of these to get back up to their highs? Is there a way for us to be looking at bases that are forming maybe lower in the overall structure on a weekly chart?
Yeah, well, I think visitors to investors.com and readers of IBD Weekly have probably heard the term bottoming base a little more often, and I've made some decent money on a couple of them recently. So I think it's just important that people still get a little confused as to how to recognize a bottoming base. So we've got two good examples of what to look for, but in this current market environment where, I mean, yeah, you've got some healthcare names that are back near highs, but you still have a lot of stocks that are 30, 40, 50% off their highs that can show pretty good technical action while they're off their highs. So we call that a bottoming base. They tend to form when a stock is stock can be 20, 30% off its high or more when a bottoming base forms. So I think it's just important to learn how to recognize them, and we've got a couple of examples here.
So you want to go over the first one here, the Ollie's Bargain Outlet? Do you want to start off with that one, Ken?
Yeah, sure.
Okay, so Arusha has showing his MarketSmith, and so again, just as a reminder for folks, you can always check out the video here where we'll go through some of these charts, and that's at investors.com/podcast. So, one of the things about Ollie's, as you mentioned, this was pretty far off its highs. If you look at where it topped out. So is there anything as a precursor? I mean, pattern recognition is picking up the base, but is there anything that you need as kind of a precursor to that base before you even consider it? Anything on the fundamental or technical side?
Well, first of all, you need a prior uptrend, and that's the most important thing about a bottoming base, because people will see a stock go, 20%, 30, 40, 50% off their high, and then, when it's it's fallen 60% off its high, and then it starts to move sideways. It doesn't rally. It just kind of tries to grope for a bottom and move sideways, and then it maybe tries to break out from that pattern. But that would not be a bottoming base, because there was no prior uptrend. So I think with Ollie's, there you have noted the prior uptrend. You can see the stock was down, 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 and then it tried to put in a bottom, and then it started to rally. There you go, and there's your uptrend. So the stock was, showing strength ahead of the base forming. And see how far the base formed off of the 52-week high. But this is one that worked. I know, this one was brought up on IBD Live again by David Ryan, when it was. He was just noting the stock's strength. And I actually got in this name on June 16th. It was a little after the move above the 200-day moving average, but I was not interested in buying Ollie's if it were not able to retake that 200-day line. So I wanted to see the stock move above the 200-day line, and then just kind of make a case it was finding support above that price level. So on June 16th, was the day it was up only 0.7% in light volume, but I just it was still in buy range, holding above that 200-day line, and that has turned into a nice winner, just in a small group of stocks, and I'm holding with a nice profit, and hope to be able to sit with this one for a long time.
What about like relative strength? Are you looking at the relative strength line during this time when considering potentially buying it?
Yeah, absolutely. And you can see in Ollie's relative strength line really started to swing nicely higher when it moved above its 200-day moving average. So yeah, and typically when a bottoming base is forming, I'm not looking at stocks with relative strength ratings of 30 or 40 or 50, really, really low like that. I don't remember what Ollie's relative strength was at the time around June 16th when I bought it, but I know it was solid. And so this was, just a classic bottoming base that yielded a good entry. But we were just talking about wanting to see the Nasdaq and the S&P 500, if they can eventually get above their 50-day lines. Can they find support there? Can they hold it? Can they even trade sideways and move above it? And that's generally what Ollie's did when it initially moved above the 200-day line that was on June 8th. It just kind of straddled the line for a little bit, and then when I picked it up on June 16th, it was making progress from the 200-day line again. So just a good example of a bottoming base that has worked out nicely.
How important are the fundamentals in this case? So, I mean, for Ollie's, you look at the numbers and there's a lot of red. The growth here has had some negative numbers on both the top line and bottom line, earnings and sales. Now, granted, we always say that the market is a forward-looking mechanism. It's looking 6-9 months out into the future. So what kind of gives you the confidence that, hey, the numbers might be bad now, but they look like they could be getting better, or is it just a technical play completely?
Well, I mean, for me, the big annual estimate, Ollie's is currently in its fiscal 2023. Fiscal 2024, they have a big annual estimate there that caught my eye at 48%. Those green arrows on the MarketSmith chart mean that estimates have been headed higher. And then we were talking about Ollie's latest earnings report, and they gave a pretty good outlook and talked about pretty strong business going forward. And it's in a good industry group, because Ollie's Bargain Outlet and a lot of these discount retailers have been showing relative strength, because the thinking is they're going to be able to do pretty good business even if the economy is in a soft spot here, because of the value proposition that they offer.
Yeah.
So
Oh, go ahead, Ken.
Yeah, no, but that was basically the picture that Ollie's that Ollie's painted for me. But I have to say the technical, probably first and foremost, it was a technical buy. I don't remember the last time. In fact, I don't think I've ever bought a stock that showed 4 quarters in a row of declining earnings and sales. But I know that a lot of retailers are in a special situation as they try to come out of they're coming out of COVID and lockdowns. There's a lot of recent earnings and sales that look like this, but a lot of these companies feel like they're turning the corner as well, and I think that's reflected in the big annual earnings estimate that they have for fiscal 24.
Yeah, and when you look on the weekly chart, you can just see a number of pretty nice big blue bars right there, showing some those skyscrapers that Bill O'Neill would always talk about. Now the other thing, well, my other question here, Ken, was that pattern recognition actually picked up a base here. Is that a requirement that you look for in a bottoming base? Is that just like, does that maybe move it up a tier? That, wow, it actually picked up one of the kind of the bases that we recognize and we ideally want?
Well, it just confirmed what I knew, is that there wasn't a little bit of a prior uptrend. And again, I think that when we're talking about a prior uptrend, we're not talking about a 5 to 10% rally. We're talking about, I think, what the number is 20% minimum, maybe even a little more than that. So we want to see a meaningful uptrend, and Ollie's showed that. Pattern recognition is for the most part pretty accurate. It has a few little missteps here and there. Sometimes it recognize double bottom patterns that maybe a little bit questionable, but it's pretty good about recognizing cut bases, whether they're forming near highs or forming well off highs, like what happened with Ollie's.
And it's probably worth just taking a look at the monthly chart, just as a reminder that Ollie's had this phenomenal run after its IPO, and this happens a lot of times with retail when they're expanding, and it's kind of a newer name, and it's opening a lot of stores. You've seen that with Chipotle Mexican Grill, so whether it's retail restaurants or retail just in, purchasing. So when something has such a strong move like that, and then kind of goes nowhere for years, is that something that concerns you? Is there a depth here? Again, how far it came off? Do you have any concerns? Do you need to see something else in order to, I guess, give you that conviction that the worst is over?
Yeah, I mean, I have to be honest. I mean, 99.9% of my technical analysis is done with weekly and daily charts. In some situations, I mean, for Ollie's, it's good looking at that monthly chart, because you're right, they went through a really rapid growth phase in their early stages of being a publicly traded company, and then it had a couple of sharp pullbacks. But I'm just kind of now I'll step away from the monthly, look at the weekly chart. What are the elements of this bottoming base that are forming? What are they saying on their earnings conference calls? And I just ask just to try to check as many boxes as possible. So first and foremost, like I said, 4 straight quarters of declining earnings and sales is not anything to get excited about. So the technicals really trumped everything here, and it's worked out well. And I'll just kind of post breakout, the stock has done absolutely nothing wrong. So I may decide to trim the position if it pulls back to a short-term support level and doesn't find support. But at this point, I could probably just wait for maybe I won't wait all the way down for a test of the 10-week line, but that 10-week moving average is still holding above the last buy point. So still looks good to me.
Mm-hmm. So another example that you had for us is Grocery Outlet, and the ticker symbol on that is GO. This one's almost right there back at new highs. It's had a phenomenal move off of its bottom. So in a lot of ways, it just looks very extended right now. It has barely given a break. So what was it about this one? Just kind of walk us through it again. Those elements of the bottoming base that were in place for you to get an earlier entry on Grocery Outlet.
Yeah, so I can't tell if it is pattern recognition recognizing that the bottoming base. Yeah, right. I can't tell.
It's consolidation. It's picking.
It's a little
It's
consolidation.
actually
Yeah,
up though. Yeah.
same difference. Sort of a little shallow cut base, and then the breakout was in early March. I wish I could say I bought this when it broke out of the bottoming base. I didn't, nor did I get it off the that 10-week moving average. But I'll give you my reasons why I eventually bought it. But again, with grocery outlet, tracked in the same industry group. As Ollie's, by the way, so people tend to think of grocery outlet maybe being a supermarket operator, which it is, like Kroger, but it's more of a a kind of big buy big at grocery outlet. So it's in a strong performing industry group, and you had again a nice little prior uptrend, Justin. If you can just kind of point out, yeah, there's your prior uptrend, and then the stock pulls back, and then again, base is forming below the 40-week moving average, but it eventually breaks out, finds support at the 10-week moving average. Now let's go back to the daily chart here, because I don't have as big a gain on grocery outlet as I do with Ollie's, but I bought actually both stocks on the same day, June 16th. So when I saw after the 10-week line, I said, this stock is really showing relative strength. I went to the daily chart and then watched it pull back very orderly down to the 21-day moving average. And on June 16th, when it crossed that recent high of 39.50, and there was good volume in the stock, is when I bought it. So I don't have a gain of, it's obviously a new holding, and it was a bit of an unconventional buy for me, but it was another good example of a bottoming base that launched a really nice price move here. So the buy wasn't as well timed as Ollie's, but it did work nicely after I picked it up off the 21-day line. And I have to say I've been doing more of that lately. We're not really getting pullbacks to the 50-day moving average at this point, but pullbacks to short-term support levels like the 21-day. Have can be a viable entry in my view. So that's what I did with grocery outlet, and sitting on a gain of close to 10%.
Now, will you when you're buying off the 21-day and out of a smaller consolidation like this, are you going to treat it a little bit differently with Ollie's? You were going to give it a little bit more room, let it test the 10-week line if possible. Are you taking that same kind of approach with this, since you bought it a little bit higher than the 10-week line?
Yeah, no, it's a great question, and I am handling those stocks differently, because I don't have as big a profit cushion with grocery outlet, and because it was a bit of an unconventional buy. I mean, I wish I could have gotten it off of the first test of the 10-week moving average. That would have been a good entry as well. But because I got it when it was crossing over that 40 level. This one, I'll wait and see, just what a test of that 21-day line looks like, which looks to be right around 42. Yep. And may decide if there's a bad break there, might just cut ties with it. And but that only because the buy was a little later. With Ollie's, it was really in the early stages of breaking out of that. It was breaking out of that bottoming base. So bigger gain and more cushion, so I can have a longer term view with that one.
And can we just real quickly address, maybe go back to the weekly chart on grocery outlet here? And for a while there, the action on this was just really, like going back to 2020 and 2021, it seemed like every time it was making progress, an earnings report would come out and just whack the heck out of this thing. And that kind of left, again, thinking of this from the bottoming base, as soon as it crossed above that 40-week moving average line, it just felt like there was all of this overhead supply. So is there a time period in which, I'm not as bothered by that overhead supply anymore? Or is that something that you're always taking a look and seeing, okay, how do we move when we get up to those prior levels where there's a lot of congestion, a lot of, trading? How do we handle it? Or is it, it's old enough that it just doesn't matter anymore?
Well, I mean, overhead supply should have been an issue with Ollie's as well when it started to move out of that bottoming base. But when grocery outlet first started, breaking out, it moved above the 40-week and the 10-week lines were nearly or converged just before or just after the stock eventually broke out. So I really didn't look at. I didn't really look at the highs maybe in January 2021, November 2020. Not really thinking that overhead supply was going to be a big problem for the stock, only because I saw how it was rallying after the breakout. Remember, this is a stock that had many up weeks in a row, and we'd like to see that. I know Bill O'Neill calls out in his book, and you look at. I mean, there were
it's like 10
many
weeks up in a row.
Yeah, 10 up weeks.
And all closing at the top of the range too.
Right.
So,
exactly.
Yeah.
So that's one way a stock can easily overcome overhead supply. So then after that it just made a nice pullback to the 10-week moving average, reversed higher with some volume, and then after that first test I was like, okay, I really feel like I need to find a way into this stock. So that's when I started watching it after that. First test of the 10-week line, and then I saw a pretty constructive pullback, short-term pullback to that 21-day line, and started a small position, and we'll see how it goes.
So far, so good. Well, when we come back, we're going to take a look at a few of the stocks that are on Ken's radar right now. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with Arusha Pires, and our special guest this week, Ken Shreve, Senior Markets Writer at Investors Business Daily. So, Ken, you just kind of laid out a good bull case for some of these bottoming bases, and let's take a look at some of the stocks that you have on your radar right now, and we might as well start with DQ. I think it's a perfect segue since you just talked about bottoming bases. Here we have another bottoming base. Tell us what you were seeing here on DQ.
Yeah, I mean, this is when you look at solar stocks, which is probably the most volatile industry group in the market. And I look at how DQ is trading, and I compare that to TAN, a popular solar ETF, which is still kind of stuck under its 40-week moving average here, and having a hard time getting price momentum. But I look at DQ's chart, and this feels like another stock that I want to own at some point, and I don't yet, but I'm encouraged. Not only was this a great breakout shown on the weekly chart here from a bottoming base, but the way this stock has traded post breakout in a very difficult tape has been super impressive. So, studying charts like this, it just alerts you to really strong stocks. It doesn't mean that really strong stocks aren't viable all the time. And DQ is has rallied powerfully after that breakout from the bottoming base. You can see the first down week, it tried to come down. It retested the prior buy area, closed up near its high, so that week wasn't overly concerning. Went on 3 straight gains after that, and so far this week the stock is we're midway through the week, and the stock is trading in the upper half of its range. So we go to the daily chart. And this is another pullback to the just a pullback to the 21-day exponential moving average, which is compelling. It's had a 3-day decline Friday, Monday, and Tuesday. The stock closed up near its high. I like how volume today was higher than Tuesday. So this is an example where volume wasn't super impressive today, but actually it was slightly above average. And anytime volume is above average in this low volume time for the market, I think that's important. So you can see DQ pulled, when it initially broke out, it pulled back to the 21-day moving average, hit a low of 52.75. It found support, and now it's pulling back to the 21-day line again here and finding support. So I would argue, I mean, if you're looking for a way into the stock, maybe just a small little pilot position here to start, keep a tight stop on it, maybe right below the 21-day line, but it's found support at this level in the past, and it's making a case it wants to find support here again. So I'm just watching DQ because of I mean it's the clear leader in the solar group at this point, and I think the action post breakout has been super impressive. And again, if you're a fan of buying off the 21-day line, which again I've done in the past, it doesn't look like a terrible entry here.
Yeah, when I look at if I go back to the weekly, over the last few months, I just see a lot of wide ranges, but DQ is able to kind of finish near the top of its ranges pretty consistently. So for something like that, if you're dealing with a more of a volatile stock, are you trying to give it more till the end of the week to see if it continues to hang in there?
It's a good question, and in a case like this, I don't know. I mean, I was tempted to pick some up today. I didn't. But that waiting towards the end of the week or even late in the session is something that I've been probably doing more of lately. How many times do you buy a stock during the first half hour, first 45 minutes of trading, and you're like, geez, I should have waited till
Yes.
I should have waited till midday because we're in such a volatile market these days. It's generally a good rule of thumb to at least wait and let the stock's personality develop over the trading day. So I'm a big fan of buying late in the day, but on Leaderboard we don't make a lot of our sell decisions until Friday, when we see how a stock is reacting around that 10-week moving average. If it closes the week 2% or 3% below the 10-week line, we're generally going to cut the stock loose. But we use that 10-week line at the end of the week a lot on Leaderboard.
Mm-hmm. So maybe we can address the elephant in the room. This is a Chinese stock, and a lot of the Chinese stocks, between regulatory issues, shutdowns with their zero tolerance policy for COVID, it just made kind of China and Chinese stocks in particular really kind of become a sore spot for a lot of investors. So is there anything, and even this week, I mean, we had that fine against Alibaba, and while it was small, it was still enough, I think, to rattle some people, like, uh-oh, here we go again. So how do you kind of get over that, I guess, that fear that's been kind of instilled in a lot of investors?
Yeah, well, I mean, I basically look at two stocks right now in China that are swimming or marching to the beat of a different drummer, or they're just they're standing out, and that would be DQ and also Li Auto, which is also pulled back to its 21-day line today. So amid a lot of regulatory scrutiny, these stocks are just not doing anything wrong. So I'm really just focusing more on price with both of these stocks. I mean, the China wild card is definitely there, but that's why we have tight stops. And a name like DQ that has been super strong, and it may not pull back to the 50-day moving average, which is why I'm kind of looking at it right here. But if I do pick some up off the 21-day line, we'll keep a tight stop on it, like I said, and market will tell us soon enough if the timing was right.
Right. Now, one of the things that you mentioned earlier, you were talking about how our invested percentage on the leaderboard model portfolio is about 23%. And it's worth noting that a good majority of that is in the medical sector. And you've already mentioned how that's one of the areas that there have been more setups on. So maybe we could shift over to one of those medical sector names and take a look at HRMY. That's Harmony Biosciences. What's your take on what's going on in this sector and this stock in particular?
Well, yeah, healthcare sector is a big sector. I mean, you've got everything from managed care firms, you've got some medical technology companies, you've got your biotechs, your health insurers, your hospital operators. So it's a big sector. But we're seeing pretty broad-based strength. So Harmony Biosciences, looking at the weekly chart here, first thing I like about this is that it's still early stage, no matter how you look at it. You're not looking at a stock that has trended and rallied 4, 5, 600%. It still looks to be an early stage move here, and you can see the weekly chart is as it just yielded a breakout. So we go back to the daily chart here, and I just really like the way this one has pulled back in recent days. I mean, you look at it's several down days in a row. I think four down days in a row, and the stock has closed up near its high every single day.
Go down.
It doesn't want to go down,
or stay down at least.
Yeah, and so again, I mean that charts tell all kinds of stories. This is a story of strength and support, and it may or may not work, but we just want to make sure the odds are in our favor here. And if it's telling a bullish technical story, we want to keep track of it. So you had an initial breakout here below the 50 level. There was a nice little cup with handle base that formed, and a solid breakout. And then picture perfect action after that first breakout came down to the 10-day moving average. Didn't make a serious threat to violate that, and then it found support. And then that little short to consolidation, not the best of handles, but it did qualify as a handle. I think if you go back to the weekly chart, this handle did not show up. I could be mistaken.
Right. Yeah, it was actually a positive week.
Yeah. So the second handle didn't show up on the weekly chart, and typically I like to see a handle on a weekly chart. So the second handle this one formed did not show up on the weekly, but it was able to break out over that alternate entry, and the stock is just handling the pullback very, very well here. So just doing a little work on Harmony. Is basically neurological disorders that this company focuses on. The stock got a downgrade today by Goldman Sachs, and you can tell it was down early like it was yesterday, but again, the stock shrugged off the Goldman neutral to neutral, and then the prior week I forgot who it was, but they got a upgrade to buy, and a nice price target as well. So I think there's a lot to like about here. With biotechs, we like profitability, we like revenue growth, and you have it in spades with Harmony Bioscience. And fund ownership has been increasing quite a bit in recent quarters. Don't have any IBD top funds in there, but you are seeing meaningful increases in fund ownership. So I think this is another good one.
Yeah, and like you said, out of this space, at least on the kind of that first handle that it formed, it went up. It acted perfectly. I mean, it went up 20+%. Now, in this type of environment, a more challenging environment where you're not necessarily seeing powerful follow-through days or even powerful breakouts for the most part, are you a little quicker maybe to say, hey, I'm up 20%, let me start locking in those gains?
Yeah, absolutely. And let me be clear. I do not own this stock, but I am watching it and want to try to find a way in. There's enough here that I think warrants a closer look. But yeah, I mean, listen, technical environments have the best chance of working when you have new institutional money. You've got growth fund managers that are accumulating shares, and that really has been a missing ingredient for quite some time in the bear market that we're in. That said, there are a few that work here and there, not many, but Harmony is one. If I bought at that early, at the first cup with handle breakout, I wouldn't be afraid to be taking some money off the table here, even though, listen, it's just been finding support at the 10-day moving average and not doing anything wrong. And again, I think the stock's price action over the past 4 sessions is pretty telling that this is indeed a very strong stock in the biotech sector.
Mm-hmm. And I should disclose that I actually do own a position in this myself. I was, as you were speaking of it, I'm like, oh yeah, wait, I do own this. That does.
Well, we should ask Justin then. In this environment, or are you taking 20% if you get the chance?
You know what? I am trying to take my profits a little bit quicker, but I will say that in medical, in a lot of the medical names, I've been a little bit slower to take those profits just because that seems like an area of strength. But that is still my goal. I don't have a 20% gain on this one yet, but I didn't quite get in there at that breakout. But yeah, I am trying to take things. It just seems like it's a little bit more of a swing trading environment as opposed to let's hold
position.
Position trading. And I'm certainly not like using a 8-week hold rule. I just don't trust holding anything for 8 weeks at this point. With the headlines and the volatility and everything like that. So it's you can still use, I think, the moving averages. I certainly don't want to be too hasty in getting out of some of these leaders, but I'm not treating everything like it's going to be a home run. It's certainly more singles and bunting than anything. Speaking of medical, why don't we go ahead and finish this up with another medical stock? And this is one that I actually didn't have on my radar. This is AXNX is the ticker symbol, Axonics. Where'd you find this one?
Good question. I think I found it in the MarketSmith Growth 250.
Okay.
And it may be new in there. And listen, there are issues with this stock, but what jumped out at me was the fund ownership here, and just a very large number of IBD mutual funds that are in here, and you can scroll down and see the Columbia small cap growth. I know you've had the people from Lord Abbott on the podcast. So Lord Abbott Developing is in this, and 2 others. So when you see fund ownership like this, I think it's worth paying attention to. The weekly chart, it's just kind of like a big, long, sloppy consolidation here. But maybe we go to the daily chart and just take a look and see what it's doing here. So again, this is a healthcare stock, not biotech. It's in the medical, the systems equipment group. They provide technology that helps treat overactive bladders. It's not profitable yet, but it does have the revenue growth, and it's got the fund sponsorship. So the revenue growth the company is showing and the fund sponsorship just has me interested in this name. When it broke out over the $60 level, there was some pretty good volume. The pivot was 59.20. It's handling the breakout pretty well, holding the 10-day line, holding near the 60 level. So I want to do a little more work here because, again, technically it's not my favorite setup. However, it's got a relative strength line near highs. The stock is clearly showing relative strength, and you got some higher volume gains there in recent days. So between the fund ownership and the pretty impressive sales growth in recent quarters, the fact that it's not profitable yet doesn't entirely bother me. But I was really struck by the fund ownership here, and at least tells me I should be doing a little more work on this one.
And I might just mention that it looks like it has that bottoming base look to it. So what would you consider the prior uptrend here? Is that kind of the January, February, March time period? Kind of that, are you using that as your prior uptrend? And then the base, and I kind of like, as deep as that, how deep was that base?
42%.
So a little bit deep at 42%, but it seemed like the next time it came in, it was a much tighter and more reasonable drop.
Yeah, and so there, you're right, spot on there with your prior uptrend. So when the stock, hit a high of, I think it was what, 60, 65, 95. Is that what it says?
Yes.
Yeah, and then so a couple of things. I mean, the left side pullback was a little bit concerning because you had an earnings report in here, the latest earnings report that the market chose not to respond well to. So you had really two harsh down sessions in a row. But on the you go back to the weekly chart and you can see what we would call a nice support week at the bottom of the base. So while the weekly structure has a bit of a wide and loose appearance to it, I do like the support week at the bottom of the base. That tells me that there were buyers in the stock lifting it off lows, and then from there it was able to just rally higher, complete a little cup with handle base, and it broke out, and it's just holding gains and showing strength and support after the breakout. So thought this was interesting one to monitor. It's really hard, finding the perfect. There's some markets that are going to give you a good tight setups with great price and volume action, and then you're in a market like now where it's hard to find the perfect chart out there. So sometimes you just have to see if it can stock and check as many boxes as possible. This one has plenty of positive traits. It has some flaws as well, but so far so good with the latest breakout, and we'll see if it can garner more price strength.
Now, this is a little bit of a smaller stock, a little under 3 billion market cap. Do you treat those a little bit differently in this type of environment, or are you going to kind of treat them all the same as a large cap stock?
Yeah, because I mean, this one is prone to volatile price swings. It has tightened up quite a bit in recent weeks, which I like. But so typically, I think that I'm kind of going with the tight price action lately, and letting that trump everything else at this point. So. There's a lot of good action in the healthcare sector, and I haven't had a chance to go through the systems equipment group in its entirety. But the first thing I noticed here, like I said, was the fund sponsorship. So there's obviously something interesting, going on here. So maybe a little more due diligence, and but I like the most recent breakout is acting quite well.
Well, and to your earlier point, it might be a little bit difficult to find kind of those picture perfect, bases and things that we're used to seeing in an uptrend, since we have had this bear market that we've been dealing with. But certainly it feels like the bottoming base is a nice arrow to add to your quiver, a nice tool to add to your toolbox, so that you have another way of getting into some of these stocks where maybe the traditional buy points that we typically use are going to be a little bit late, and this could give you some early entry. So thank you so much for sharing your knowledge here today, Ken. We really appreciate it.
Hey, it's always consider both of you guys good friends. Known you both for a long time, and always a pleasure coming on with you.
Okay, so on our show next week, we're going to welcome Will Rind back to the show. He is the founder and CEO of Granite Shares. So we had a great conversation with him, a lot of technical action that we covered. So we're looking forward to having him back on the show. That's going to do it for us this week. Thank you so much for joining us. Thanks for watching, and we'll see you next time. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.